Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. There's quite a bit to talk about today. In fact, last night, you had a meeting of the group of ministers that's talking about GST. And specifically, one of the items on their agenda was health insurance and life insurance premiums that are paid by individuals. And there was a consensus in that meeting that it should be exempt from GST. That GST amount currently stands at 18%. So if this is to be exempted, and this is only going to take place once the council of the GST meets and decides it, but if it is to be exempt, what happens to your premiums? If you've already got a health insurance policy or a life insurance policy, does that mean that your next premium payment will reflect this change? And if you are to buy a new policy, will you actually see your premiums come down? That's what we're going to discuss at the start today. But before we get to our first guest, who is Aditya Shah, who is the founder of Hercules Advisors. And Aditya, thanks so much for joining in. I want you and the viewers to listen to a conversation that we had with an ex-member of IRDAI, Nilesh Sathe, about how this works, because there's a question about input tax credit and what the implications of that would be. Listen in.
Initially, the premium, suppose, was 1,000 rupees for 1 crore term insurance premium. 1,000 per month, let us say. Now, premium was 1,000, but 18 rupees was going from his pocket towards GST. So indirectly, he had to shell out 1,180 rupees for the cover per month. Now, what will happen? This 180, he doesn't have to pay. So the premium will be 1,000. But the insurance companies used to get input tax credit on this 180 rupees. Now, what is input tax credit? The expenses which are incurred by insurance companies, they have to pay GST on services, while they receive GST on account of premiums that they receive. Let us work out to what extent the premium will go up. Insurance companies have been saying that premiums have to go up because we had factored in the input tax credit while arriving at premium of, say, 1,000 rupees. Now they are not going to get. So let us see to what extent the premium may go up. How 1,000 is calculated? There are three assumptions, basic assumptions. One is mortality, which is a major assumption. On 1,000 rupees, if the premium is 1,000, the mortality assumption may be about 700 rupees because that is a major assumption. The second is expenses. Third is for solvency margin, for profit and all that. Now, for expenses, suppose the provision is for 100 rupees. On 100 rupees, they used to get 18 rupees as input tax credit, which they had factored in. Now they are not going to get this 18 rupees. So on 1,000 rupees premium, there is a possibility that premium may go up by 18 rupees, which will be hardly 1.8%. Bear it in mind. It's not going to be that significant.
So there's nothing to worry about. That was the sum and substance of what Mr. Nilesh Sathe was telling us this morning. But what does that mean, and what does Aditya Shah think about it? Aditya, thanks so much for joining me once again today. And I was speaking to you before the show, and you said that you don't think that premiums will come down by that much. Why do you say that?
As the other gentleman was explaining, the input tax credit, as I said, as he also said, input tax credit will not be available for companies. And if input tax credit is not available for the companies, there's no material calculation as to how much that will affect the expenses of the companies. And if the expenses of the companies continue to increase each year, ultimately what will happen is the premium will then tend to be equal to what the premium is today, or maybe even higher. So a smarter solution would be to either put insurance at about 5 or 12% GST, and then take an input tax credit so that at least 6 to 7% of that premium increase is passed on to customers. I don't think at 0 or 5%, GST, there will be a material decrease in the premium that users end up paying. And mind you, this is very, very significant for senior citizens, because senior citizen premiums are tending to go towards 1.5 lakh rupees for a 10 lakh cover, and there a GST reduction was immediately needed. So from my perspective, this is good news for the industry, but I don't think the full 18% impact will come to the consumers. It will be somewhere close to 5 or 7% is what my guess is.
So at this point, we don't know the nitty-gritties of it. So you have a more conservative estimate than a lot of other people, Aditya. And some people are saying that a 15% reduction could potentially take place because 18% is going to zero. It may be less than that, as you've pointed out. So, but in a range of 7% to 12 to 15%, let's call it that, right? So how is this going to work? Is it going to only reflect on new policies, or will it also reflect on existing policies where you're paying a premium, say, every month or every year?
So there are three aspects to it. One aspect is if you have bought multi-year policy and you've already paid GST, the GST will not get refunded to you. And for if you paid a 3-year policy, if 2 years are left, you have already paid GST and you will not get a refund on it. The second aspect comes from here on, from the day the GST change is implemented, from there on, all existing and new policies will have to move to a newer tax regime. And if that is 0%, then your existing premium will also get readjusted for GST. So in every policy, there is a component. Premium will not get revised. It will only get revised if the taxes are revised. So here, if taxes are revised, all new and existing policies which come up for renewal after the effectiveness of the tax cut will get the new policy. But at the same time, insurer will also have the right to increase the premium if they see the expenses moving up.
Now, therefore, the tendency is, and you've just described that if you've already paid, then there's no refund. But there's a possibility if you have an existing policy that you can see an effect. So the question that I have is, like you saw with the announcement on the potential GST cut in the consumer durable space or in automobiles, because ultimately the move is gravitating towards two slabs by and large. And we're not talking about insurance here, we're talking about a 5% slab and an 18% slab. So the tendency or the desire would be to get a better rate down the line, to say, I will defer my purchase. If I was in the market for a car right now, let me see if I get the benefit and a fall from 28% to an 18%, if at all, because that's a pretty substantial drop. Is there a tendency, or will there be a tendency in the insurance space as well, to say, let me defer buying an insurance policy if I get a better rate? And is that a good idea, in your opinion?
See, there are 2 or 3 aspects to it. One is the risk that you already carry. On a health insurance policy, your risk of hospitalization. On a life insurance policy, your mortality. Irrespective of the fact GST is there or not there, those risks need to be covered day in and day out. So from my perspective, the best time to buy any type of insurance was yesterday. The next best time is today. Now, the second aspect of it is GST. You see, what will happen is, as ITC credit will not be available, the cost for the insurance companies will keep rising. So my guess is in the near term, the premium will get cut, but slowly and steadily, as the expenses keep compounding, in the first year they will compound by 18%, the next year they will again compound by 18%. The premium increases in the coming years will be far more than what they have been before. So from my perspective, there is no case for deferment of deferment of insurance because of GST cut. I think in the near term, as the cuts come in and the insurers still not raise the premium, that would be the best time to lock in your 3 or 5 year policy term.
I guess it depends on how you look at it, Aditya. From my perspective, I would say that the benefit, if there is a reduction of the tax to whatever extent, and the total effect, whether it is 7% or more than that, is cumulative in nature, because as you've pointed out, the risks keep going up and the quantity of premium will keep going up, and we're talking about this as a percentage of the whole. And so as a result, if that percentage is dropped to zero, I no longer have to pay the tax on that larger premium amount as it goes up. That's another way to look at it. Would you agree?
Yes, that's another way of looking at it. But then the central point always remains that you cannot ignore risk just for the sake of buying just for the sake of saving 5-7% tax. I don't think if the government was really helpful, it would find a way, find a solution to get the input tax credit in. that would be a win-win both for the insurance industry and the government. In the near term, the government will lose out on some amount of revenue, but in the longer term, it will increase the penetration. So from my perspective, what I think is people should continue as normal with their insurance buying as per se. But I think whenever the tax cut becomes effective, 1 year from there on would be a great time to buy insurance policies, because after that, if the ITC is not available, the compounding of the costs for the companies will come in, and the companies will be forced to increase costs, increase premiums.
Important points that you're making. Aditya, thanks so much for joining in and for clarifying these aspects. The bottom line, of course, is that you shouldn't defer your purchases, irrespective of what is happening on the GST.